Hello everybody, welcome back to EduTap and I hope you all guys are doing absolutely good. So I hope that you are preparing dedicatedly for NPS Grade A and Grade B exam, and as you all know EduTap is offering you a free revision series for all the components of NPS Grade A and Grade B. So today we will discuss pension, and in pension we have our day 3 today. We have already completed 2 dedicated days for pension in which we discuss Atal Pension Yojana, National Pension System, and today we will discuss some miscellaneous topics related to pension. So if I am visible, if I am audible, and if my screen is completely visible to all of you, then please let me know in the chat box so that we can start with our session. Okay, and again I'm very sorry that I'm not able to start my camera because there is some default in my laptop, but not an issue. You will be able to see all the questions and everything. Okay, so let's start with day 3 of pension now. Let's move ahead. So before we move forward, my friends, please subscribe to our YouTube channel. That will allow you to understand multiple nitty-gritties of multiple exams related to NPS, RBI and EDI. Also, we also provide a free content on our YouTube. So please subscribe to our YouTube channel. Definitely you will get a lot of insights also related to multiple exams. And to get the PDF of this particular class, please join our Telegram channel. The link is given in the description box below. So let's move forward now to understand the schedule of this revision series. So if you see, my friends, we are currently doing the revision series for NPS Grade A and Grade B exam. Till now we have completed Companies Act and other components as well. Videos are freely available to you on our YouTube channel. Pension sector day 1 we have completed Atal Pension Yojana. Pension sector day 2 we have completed National Pension System. And today is our day 3 of pension, which is the last date of pension. And in this last date we will discuss some miscellaneous topics related to the pension sector. Okay, our major focus will be on portfolio management and some pension related schemes. And yes, tomorrow we will start with statistics. So we have dedicated 2 days to statistics. After statistics, pension, and after pension you will have, I would say after statistics, sorry, you have data analytics, and after data analytics you have your Indian Trust Act. So I again repeat, pension sector will be over by today, then statistics, then data analytics, and then you have Indian Trust Act. So make sure that you utilize all these lectures which we have conducted for you. Now let's move forward to question number 1. Question number 1 is, what does rebalancing mean in portfolio management? So first of all, what is portfolio management? See, portfolio management basically means to manage your portfolio. Now what is portfolio? Portfolio is basically what assets you are investing in. For example, somebody would invest in share market, somebody would invest in debt market, somebody would invest in mutual funds, somebody will invest in Bitcoin, somebody will invest in depository receipts and whatnot. So people these days are investing in multiple different avenues. And if you have to manage this entire thing is known as portfolio. Portfolio basically means that accumulation of all your of all your investments. So if you have invested in shares of one company, debt market, equity market, money market, long term debt market, then you have your multiple other segments, right? That you have invested in forex also, Bitcoin also. So if I combine everything, this is known as basically your portfolio. How will you manage this particular portfolio? What will be your allocation to equity? What will be your allocation to debt market? This is basically what your portfolio management is. Okay. So the question is regarding rebalancing. What does rebalancing mean in portfolio management? Is it investing all funds into single asset class? Horribly incorrect, because if you invest in just one particular asset, definitely that will be risky. Frequently selling assets without considering market trends? No, because you do not sell. You do not sell that much frequently. Yes, you can sell one particular asset after keeping it for it like 5 years or for 10 years, right? But you don't sell too much frequently, right? And this is not the meaning of rebalancing. Adjust the portfolio periodically to maintain the desired allocation. Yes, this will be your answer. Rebalancing basically means what? That if I'm not happy with one particular asset class, I will shift my money into some other asset class. For example, equities are good, so you can shift your money into equities from debt. But if you are not getting good returns in equity, then you can move from equity to debt. So this is what rebalancing means. Rebalancing means to shift your money as per the need of the time. Okay. Avoiding changes in the investment strategy? No, that is not the meaning of rebalancing. Reducing investment to only cash and cash equivalents? No, because if you just invest in cash, you will not grow your money. Okay, so the correct answer over here will be C. Rebalancing basically means that if I'm not happy with one particular asset class, then I can put my money in some other asset class or vice versa also. Okay, so this is what the meaning of rebalancing is, which you generally do at the end of year. At the end of year, because at the end of year you can evaluate, right, that how is the performance of one particular asset class vis-a-vis the another one. So that's why the correct answer over here will be option number C. Here is the explanation as well. If you see, this is the explanation, and the correct answer over here will be option number C. Now let's move to question number 2. Question number 2 is related to which of the following best describes passive portfolio management. Passive portfolio. See, passive basically is that particular word which says that you are not active. You are just passive, right? So which of the following describe passive portfolio management? Now, passive basically means that you are inactive. You just have purchased shares of one particular company, and now, my friends, that particular company will be there in your portfolio for long period of time. So you invest and then forget. You invest and then forgot. Basically, it's like you will keep a stock of one particular company for long period of time. You would have seen that people who have invested in Infosys 10 years back in the year, or if you go back, I would say by 10 or 20 years, they would have held Infosys. They would have been turning into themselves into crore-patis by now, because this is the power of equities. And if you hold the stock for a lot number of years, definitely you will also see the effect of compounding is happening, right? You would have seen people advising on YouTube that you invest in mutual funds for 15 years and then you will have 1 crore by the end of 15 years. So what is this? This is passive portfolio management. You hold the stock for long number of years. Okay, so now let's try to answer question number 2. Passive portfolio, frequently trading assets? No, because frequently trading asset is the component of active. Active means what? That you are trying to buy and sell on very frequent days. On very frequent days you are buying and selling. For example, I bought on Monday and sold on Tuesday. Again on Tuesday I bought something and sold on Wednesday. So this is frequent asset trading. Okay. Holding investments for long term to attract specific index or market segment? Yes, this is the correct one. Therefore your answer will be option number B, because you are holding the investment for long term, right? Investing only in high yield bonds? No, because if you are only investing in bonds, then you are not investing in some other asset class. So that is not the component of portfolio, right? Because in portfolio you invest in multiple asset classes. Continuously shifting investment, this is also the criteria of active investment portfolio. Relying on speculative trading strategies to maximize profit, this again is the feature of active portfolio. So what is passive? Passive basically means that I will invest my money and forget. As simple as that. Therefore the correct answer over here will be option number B. Even if you read the explanation with me, the correct answer will be option number B only. Passive portfolio focuses on the long term investment. So you put your money in Reliance today, for example, and then you will sell it after 15 years. Definitely Reliance will grow in multiple segments, because Reliance is an evergreen company of India. So your money will also grow with Reliance. Therefore the correct answer over here will be option number B only. Right? Now let's move forward to question number 3. Chalo. Now please try to answer question number 3. What is the key objective of active portfolio management? Now, active portfolio management means that you have this of portfolio. In your portfolio, you have equity, you have debt, you have bitcoins, you have forex market components as well, and you have depository receipts also. Okay, so this is what your portfolio looks like. But what is active portfolio management? Active portfolio management means that you are managing the money very actively. For example, you were not happy with equity, so you have shifted your money into debt. Next year debt was not performing good, so you have shifted your money into bitcoins. So this is active. Active basically is not like, I would say, it's not like too much long term. Rather, it's kind of shifting things in a very short period of time. You would have seen people investing in futures and options. You would have seen that people investing in futures and options. So they buy and sell very frequently. So that can be a component of active portfolio management. Now, what is the key objective? Key as in the primary objective of active portfolio management. Is it matching the market returns? No. See, if you see Sensex or if you see Nifty, Sensex is of BSE, Nifty is of NSE. On an average, year on year, they are giving you 12% return. You would have heard about this as well, right? Because it's a very famous fact across the financial industry that in India, if you invest in your equity market, specifically BSE, Sensex and Nifty, I would say of NSE, you would have got 12% return. Now this 12% return is known as market return. Market as in like index return. But if you are following active portfolio management, then definitely you should try to beat this particular return. You should try to get something extra. For example, my portfolio is giving me 18% return and market is just giving me 12%. So this extra is known as what? Alpha. This extra is known as what? Alpha. ALPHA. It's a kind of a symbol. So higher the alpha, better is your portfolio. For example, my portfolio is giving me 10% now, but market is giving 12%. So I will say that alpha is negative 2%. Right? So higher the alpha, the better it is for you. So under active portfolio management, you try to beat the index return. You try to beat the index return. Okay, like you have Sensex, which is the index of BSE, Nifty as the index of NSE. So you try to beat the returns which these indexes are generating. Okay, so you do not try to match, rather you try to beat. Therefore, A cannot be your right answer. Minimize transaction cost, no, because you will be buying and selling too much, so you will have to pay the securities transaction tax, or you will also have to pay a lot of brokerage. Therefore, B cannot be your right answer. Avoiding market risk altogether, it is not possible, because if you are able to minimize market risk, that is still acceptable, but to avoid it altogether, that's an extreme statement. Therefore, C is also incorrect. Outperforming the market through strategic trading. This is what the correct answer will be, because you are outperforming. Outperforming means you are beating the market returns. So if market is offering me 12%, I will try to go above 20. I want to create alpha of more than 8%. Okay. Therefore, the correct answer over here will be option number D. Holding investment for long term without frequent adjustment. This is basically a passive investment, not active. Therefore, the correct answer of question number 3 will be option number D. Now let's move forward to check the explanation as well. So answer will be option number D. That is what we have discussed so far. Now let's move forward to question number 4. Question number 4 says which type of fund is most likely to have lowest management fee? Now, as we all know that in portfolio management, we always invest our money, like some people do, invest their money in mutual funds. So you can get 1 to 2 questions on mutual fund as well. Therefore, we are doing the basics of mutual fund over here as well. Which type of fund is most likely to have the lowest management fee? See, lowest management fee basically means that what amount of money will you be giving to the fund manager, and which particular fund manager will have the lowest management fee. ELSS is having high management fee, because over here equity linked saving schemes, in this the fund managers actively participates in the equity market. Small cap and mid cap, these are a kind of a market capitalization funds, wherein the small cap fund invest in small cap companies, mid cap fund invest in mid cap companies. The answer will be index fund, because under index fund what happens is the fund manager or your mutual fund will invest either in some specific index like Sensex, or you can say Nifty 50. So they do not have to track too much. They do not have to track too much. Why? Because they are just investing their money in the 30 companies which are listed on Sensex and 50 companies which are listed on Nifty. So it's like passive investing. Passive investing will never generate high management fee. It will always have lower management fee. Okay, so answer will over here will be option number C, because over here the fund manager just tries to replicate the return which the market is offering. So if market is offering you 12%, your index fund will also give you 12%. So it's like you don't have to do any headache that I have to beat the market returns. Rather, you are happy with the low or moderate returns also. Therefore, the correct answer over here will be option number C. And what is thematic fund? Thematic fund is basically that particular fund which invests according to some common theme, like defense related funds, innovative schemes, that particular stuff. Okay. So the answer over here will be option number C. Let us verify also. So the answer is option number C only, that we have discussed. Now let's move forward to question number 5. Question number 5 on your screen now. Try to solve this question. In India, who regulates mutual fund? Now there can be a question in which your examiner is trying to attempt that you know that who is the regulator of which particular sector. Like banking sector is regulated by RBI, pension sector is regulated by PFRDA, insurance sector is regulated by your IRDAI, Insurance Regulatory and Development Authority of India. Capital market, securities market fall under the domain of SEBI. In the same context, mutual fund are operated or are regulated by whom? They are regulated by SEBI itself. Okay, AMFI, which is your Association of Mutual Funds of India, this is just a kind of a union body of mutual fund, but they do not regulate. They just want to make like AMFI. They just make, I would say, what, code of conduct for mutual funds kind of stuff. It's like a kind of an organization which represents mutual fund which are operating in India. But when it comes to the regulatory body of mutual fund, it's SEBI only. Okay, RBI is for banking and NBFCs. Ministry of Finance is like bureaucratic side. Ministry of Corporate Affairs is also the bureaucratic structure. Okay, so the correct answer over here will be SEBI. And do remember, SEBI is also regulating the corporate debt market, the capital market segment. Okay, so the correct answer over here will be option number A. Now let's move forward to the explanation as well. So here is the explanation and the answer will be option number A only. Okay, now let's move to question number 6. Question number 6 is related to one of the very famous scheme of Pradhan Mantri Vaya Vandana Yojana. So you have to tell me that which particular company or which particular institution is implementing Pradhan Mantri Vaya Vandana Yojana. Now this is the scheme which is, you know, a very important scheme which provides pension to the old citizens of India. So Pradhan Mantri Vaya Vandana Yojana is implemented by Niti Aayog, no. PFRDA, no. NPS Trust, no. NPS Trust is in your NPS. Okay, IRDAI or LIC. The correct answer will be LIC, which is one of the famous insurance companies in India. Okay, so Pradhan Mantri Vaya Vandana Yojana is the scheme implemented by LIC. And even if you see the explanation, the correct answer will be option number E. Pradhan Mantri Vaya Vandana Yojana is the scheme which has been implemented by LIC. And if you see, Pradhan Mantri Vaya Vandana Yojana is a pension scheme launched by Government of India in 2017. If you see APY, that is our Atal Pension Yojana, is in 2015. National Pension Scheme is 2004, right? And now I am adding one more scheme over here, that is Pradhan Mantri Vaya Vandana Yojana, launched in the year 2017. Okay, the scheme is administered by LIC, and over here if you see, they target senior citizens of India, and the scheme offers you a sure return of 7.4%. So it's like if you invest your money in Pradhan Mantri Vaya Vandana Yojana, or if you are enrolled into Pradhan Mantri Vaya Vandana Yojana, this is the return which you will like to get. This is the return which you would like to get. Now, if you want to solve more questions, please solve Pradhan Mantri Vaya Vandana Yojana. Very, very important scheme. You can do the age qualifications, what are the exit and entry points and all that stuff. Okay, but in this particular class, we have just discussed that it offers you return of 7.4 and it is administered by LIC. Now let's move to the next question. Question number 7 on your screen. Jeevan Pramaan. Jeevan Pramaan is a biometric enabled digital service for pensioners. So you are reading pension components. So now we are discussing something which we call it as e-governance. E-governance means that Government of India wants to give governance through electronic modes. So e-Pramaan, or I would say Jeevan Pramaan is a biometric enabled digital service for pensioners, aims to provide digital life certificates for pensioners. Which category of pensioners can avail the benefit from this portal? Only central government pensioners, only state governments, or all the other government organization, or all of the above, or none, or only A and B? See the correct answer. If you know, please let me know in the chat box. I am willing to see your answers. Come on, please post your answers in the chat box. Don't be lazy. Yes, the correct answer will be all of the above. According to Jeevan Pramaan, which is an initiative of Government of India, you can get digital life certificates for multiple pensioners, whether you are a central, state, or any government organization pensioner. Even if you read the text with me, with your answer is option number D. Jeevan Pramaan is a digital life certificate for pensioners in India, which was launched by Government of India in 2014. Jeevan Pramaan certificate is a biometric enabled digital certificate that authenticates the identity of pensioners and enables them to provide life certification without the need of physical presence. So how will you come to know that whether this XYZ person is eligible to get pension? That particular certificate is required, right? A certificate is required which proves that yes, you are eligible to get pension. So what is the objective of this particular certificate? I hope it is very much clear to you. Earlier, pensioners were required to visit the pension disturbing agency or a bank to provide a physical life certificate. But now we are dealing with Jeevan Pramaan. Jeevan Pramaan basically means what? That yes, I am alive and I want to get pension from the eligible offices. Okay, so that's why the correct answer over here will be option number D. One more question based on the e-governance. Try to answer question number 8. Dash is a project to channelize skill, experience, time available with the central government pensioners to meaningful social intervention. See, if a person is opting for pension, it basically means they have retired. In most cases, people retire and then avail the pension. So after your, I would say, retirement, many people feels lonely, right? Many people feel lonely, and in that particular context, when you feel lonely, there are multiple negative things which can happen with you. So therefore, to have social intervention, there is one particular portal which has been launched. Name that particular portal. This particular portal also facilitates organizations working in the area to select appropriate skills and expertise in the from the available pool of volunteers, pensioners. Identify. Identify A over here. Is it Samadhan, Tejas, Sankalp, Bhavishya, or none of the above? See, the correct answer over here will be Sankalp. Sankalp is that particular portal on which you can just, you can just list out yourself that yes, I want to take part in social interventions and I want to make friends. Like I want to live a life after retirement also. And in this particular portal, you will also get, you can contribute to the society. You can contribute to through your to the society through your skills, right? So the answer over here will be Sankalp. Option number C is the correct one. Right, so Sankalp for pensioners, this particular portal is again very very important to give a kind of a joyful life after pension. Okay, so the answer will be option number C. You can definitely read the text once you get the PPT or the PDF of this particular class. Now let's move ahead to question number 9. Question number 10 I have taken from a very basic financial perspective, because if you are making investment, you should know the basics of bullish and bearish. So what is bullish and bearish? Please let me know in the chat. What is bullish and bearish? You can give me the right answer as well. Bullish, expectations that market will go down. No, bullish basically means that market will go up. Bullish is optimistic and bearish is pessimistic. So bullish is the expectations that market will go up. Yes. Bearish is the expectations that market will go down. So you would have heard about this also in the market, right? These days market is being bearish because market is falling. But 5 years back, or I would say when coronavirus pandemic, when India was recovering, India was bullish. So the correct answer was option number B. Bullish basically means that market is going up. Bearish means that market in the future will go down. Rest all options were given to confuse you only. Okay, so the correct answer will be option number B. Here is the difference again. You can read once you get the PDF of this particular class, right? Last question of the day. Let's try to solve. Question number 10 is based on the different type of risk which you face in the investment. So read the question. The RBI in the recent report mentioned that about PNB fraud case. Okay. The central bank cited that their delinquent behavior by one of the more employees of the bank and the failure of internal controls resulted in the massive fraud of 11,300 crores. According to you, what type of risk caused such a massive risk for Punjab National Bank? Is it market? Is it liquidity? Is it credit? Is it operational, or is it all of the above? See, market risk is basically that particular risk that you have purchased a share of rupees, I would say 100, and by tomorrow the price crashed and now it is rupees 10. So market risk is basically known as price risk, so that the price collapsed and now you have no investment left, okay, or you are having heavy losses on your investment. So that is known as market risk. Liquidity risk is basically that you do not have enough funds to invest. You do not have a buyer or a seller to whom you can complete your transaction. Credit risk is basically that you, like, somebody who is about to give you money, he or she is cheating on you. So this is also known as credit default risk, that other person is not fulfilling his or her obligation. Operational risk is happening because of internal people or internal controls. Somebody in your organization has cheated on you. Somebody in your organization is not listening to you. Somebody in your organization is making sure that there are losses in your company. Now, if you read this particular paragraph, it is clearly written that one or more employees of the bank and a failure of internal controls. Internal controls is obviously a part of operational risk. Therefore, the answer will be option number D. See, in the pension component, you have a chapter which is basics of investment. So therefore, we have picked this particular question so that you can understand that every investment comes with a risk. Okay, so answer of this particular question was operational risk. I hope all the other type of risk are very much clear to you. So the answer will be option number Okay, so we have completed all the 10 different questions. Thank you for joining us in this particular lecture, and I hope all the different questions which we have solved today are very much clear to you. If you have doubt, then please let me know in the comment box, and please subscribe to our YouTube channel, and you can also call us on 8146207241 9 a.m. to 6 p.m. to get your doubts addressed. Thank you and have a good day ahead.